The real estate bubble is bursting and there's a lot of economic data coming out. So let's jump in. Comment below if you see the same things we are. It's a lot of people out there who are still sticking their head in the sand, pretending that nothing has changed while the data is showing a complete opposite story. Let's go into what happened over the weekend. On Friday, the US debt was downgraded by Moody's, which was a big move. It was a little bit delayed, but obviously we're in a US debt crisis and Moody's is calling it out. This morning we woke up to 10-year Treasury up 10 bips and mortgage rates up, which obviously the consumer is already in a really bad spot. Here's the 10-year Treasury moving up 10 basis points. As you can see, just at the beginning of May, it was at 4.2%. Now it's at 4.54%. The 10-year Treasury moves with mortgage rates because people keep their mortgages for about 10 years. And so it matches with the 10-year Treasury rate. They're highly correlated. This is a good guide if it's something that you want to watch. But this is something I look at every single day. As the borrowing costs go higher and higher, it becomes more unaffordable for consumers to be able to purchase. And this is the number one indicator for how the housing market is going to moving forward from here. So if we continue to see the 10-year Treasury climb, it's very likely that we'll have a very stagnant housing market. We are already at record lows, and we'll jump into that data as well, but it's getting worse every single day that goes on since the beginning of May. Frankly, the number one issue is that consumers are maxed out. There's credit bubbles all across the United States. The US government is in debt. People have auto loans that are, defaulting at a rapid rate. They're loaded up with student loans. They've pulled out money out of their HELOCs on their houses, and now their equity is starting to evaporate. And inflation has come up such a significant amount that consumers are maxed out. So let's take a look. They're loaded up with debt. FHA, 65% of purchasers have a debt to income ratio greater than 43%. VA loans greater than 55%. So these people who are getting these 0% down loans for VA or FHA 3.5% down, they are loaded up with consumer debt already, and now they're buying at the peak of the market. They're likely to be underwater. If they lose their job, they're just one missed payment away. And the reality is, they don't have any savings either. They're running out of cash. So all the cash that they had accumulated from passing out the $2,000 during the COVID years, all of that has basically evaporated away. Credit card delinquencies are starting to skyrocket. This is huge. This is the percentage of people with credit card debt that is 90 days delinquent. It is now as bad as it was during the tech bubble. And this is a huge indication that the consumer is maxed out. They're starting to be delinquent. Payment is coming due. We see a lot of the buy now, pay later business out there that's starting to pop up. And it could not be worse for the consumer. The average consumer is just getting crushed right now. Further, this is a really cool chart. It shows the highest rates of student loan delinquency are actually concentrated in the South. So I'm in Jacksonville, Florida, which is right here, and the share of borrowers with the payments that are past due. So, this dark red here is 30% more. Obviously, you can see that in the South and then Florida. But student loan delinquency skyrocketing is a problem because the borrower and the co-borrower, often the student's parents, are going to have their credit hit by up to 100, 150 points, which is going to impact their ability to borrow or their interest rates when they do go to borrow, which is obviously going to hurt affordability as well, because a lot of people who are buying right now, if they're a first-time home buyer, they're getting help from their parents. There's been basically no wage growth when you account for inflation over, the last decade. You could see this is the dollars that are left over after food, gas, and personal interest from rent for the median household. And this is the real wage growth right here in this black line. And as you can see, it's actually lower in some cases than it was in the 2000s. So, it's very compelling to say, oh, you just need to work harder, you lazy millennials on social media. But the reality is that, wages just haven't kept up with the price of everything that needs to be purchased to live. And here's another chart that shows that the wages aren't keeping up with inflation. This is a cool chart that came out from Visual Capitalist. It shows the income needed to buy a home in 2025. And so in Florida, you need $125,000 salary or income to be able to purchase a home. That is a lot of money in Florida. If you're in Jacksonville, I think the median income for a household is like 52,000. So it'd obviously have to be dual income or subsidized by parents. So the local populace is no longer able to purchase a home in Florida because of the affordability issues. And the math isn't mathing. Realtor.com is even saying it. Buying in a home in 1985 versus 2022, the baby boomers, right? They were making $23,000 on median household income, and their house was $83,000. Well, today, millennials are making $74,000, and the median home price is $468,000. I mean, if we do a 3x multiple there, it should be like $210,000. So it's just the numbers, no matter how you cut them, they end up being about 30-40% higher than the trend line. And that is really concerning. And obviously that's creating the affordability crisis. And that's why consumers feel awful. So this reading just came out from the University of Michigan. The consumer sentiment has plunged to 50.8. This is the second lowest reading of all time. And it's likely to get worse. The consumer feels like they have no money. There's no way out. And frankly, the first-time home buyers cannot afford housing. So this is the first-time home buyers' share of home purchases. This comes from the National Association of Realtors for Existing Homes. And as you can see, it's well below the 20-year average for first-time home buyers. And not only that, get this, the median age of a home buyer is now above 55 years old. So, I mean, that's just a crazy stat. You can see how much it's come up over the last couple decades here, but it's starting to skyrocket because they're the only ones who have any money, who's able to purchase at these prices. Or you have to get, obviously dual income, you might still be able to purchase. Or if you're getting money from mommy and daddy, who's able to support you in your home purchase and gift you your down payment and things like that. So this is just an indication that we are absolutely in a housing bubble. When it's going to crack, we don't know, but obviously the 10-year coming up today over the last month quite significantly is a drastic sign that things are starting to change. And the reality is this affordability crisis impacts so many people. And this chart's really cool. It's from the National Association of Home Builders. And it says that, U.S. households buy highest price home they can afford. So there's 52 million people out there in the United States who cannot afford higher price than $200,000 at today's mortgage rate. These numbers are just really scary, but you can see how many people are able to actually purchase in each segment of the market. And the credit bubble is impacting real estate. Housing inventory is skyrocketing, and it's simple. Builders have overbuilt in Florida in the past 4 years, and hedge funds have stopped buying in 2022. Just to comment on hedge funds, they were in Jacksonville since 2012, 2014. They're buying 40, 50, 60 homes per month in the affordable price points, right? They're buying 4 bedrooms, 2 bath, 2,000 square feet for about 180 to 200. Those homes now, if you were trying to buy them, would cost about 450. Then we're seeing a slowdown in migration to Florida, which is a huge issue. We had all these people come during COVID, and they were looking for pool homes, and they were just having a wonderful time. And now the migration is starting to turn the other way as we have return to office. People are going back to where they came from. Maybe they had a culture shock. Maybe they lost their job and they can no longer afford to live here on the salaries that Florida pays, because people were trying to get double dip and get the best of both worlds. They were trying to get the money from the north or the west in terms of their salary, but live in Florida and, obviously have the no state income tax and get some savings there as well. So they were trying to get the best of both worlds, but the migration patterns to Florida is slowing. And the local population, as we just looked at, the median price for the median wage, they're just priced out. They cannot afford to purchase. So the question is, if people aren't moving here and the local people can't purchase, who is buying? Who is able to purchase at today's interest rates? And that's why we're seeing the inventory continue to stack up. This month, year over year, for April, was down 31.3% in pending sales in Northeast Florida already, and it's busy season. So as you can see, we're going to be seeing some more pain ahead. Now, what's actually happening? You need 70% more income to be able to purchase. That stat came from realtor.com. Home prices are up 52% from 256 to 400,000 for 2019 versus today. Mortgage rates went from 4% to 7%. Affordable homes were purchased by the hedge funds, and the wage growth is just simply not enough. And this impacts Florida because 10.8% of homes in Florida are second homes. So this is the demand for second homes actually fell to 6-year low in 2024. It'll be really interesting to see what happens in 2025. We also had this crazy wave of Airbnbs where everybody wanted to be an Instagram star and buy an Airbnb and show how cool it was, and run a mini hotel in somebody's neighborhood or in somebody's condo association. And now those numbers are no longer making sense with how much insurance has come up. Insurance has come up 72% in the last 5 years in the state of Florida. Taxes have come up, and the home prices have come up. So it's just an absolute, in mortgage rates, none of it together pencils out on paper anymore, and that's why people aren't buying their second homes, and the relocations are slowing. We actually saw some issues with Canadians selling their homes after some Trump policies got them all riled up, and so they're relocating and selling their property in South Florida. So we're seeing a lot of different changes happening that's impacting Florida specifically. And that's led to this, the lowest number of existing home sales since the great financial crisis. So if people say, we're not in a crisis, we're not in a crisis. Of course we're in a crisis. It's worse than it was before. And we have so much more inventory on a national and on a regional and local level than we've ever had before, because the builders have just built so many more properties. So it's worse than the 2008 crisis in terms of number of sales. Obviously, the inventory is slow to keep up. The reason for this is because in our market specifically, we have about 800, 900 net new listings come on the market every month, but we also have every week. Every week it's going up about 5 to 8% number in terms of the entire inventory that we have available. But we also have a record number of expired listings for people who weren't able to sell their property that'll likely come on in the next 6 weeks. So we're expecting to see a huge boom of new inventory, which is basically old inventory that's being relisted in the next 6 weeks here. And the purchase applications are also below the great financial crisis. So, again, I see these people out there saying, oh, there's no crisis, there's no crisis. Of course, we're already in it. The data is showing us that it's actually worse than it was before. And frankly, it feels like we haven't even gone into the real issues at this point. Once the market goes down, it usually stays there, at least in real estate, for up to 5 years, 7 years. It can take 10 years to reach the prior highs. And prices are shifting very fast. So this is price reduction surge as sellers overestimate the market. Nationally, 18% of listings saw price reductions in April. There's 25% of homes saw price reduction in April in the state of Florida. And in Jacksonville, I pulled the numbers, there's 35% of homes had a price reduction in April. And that's not surprising. I'm sure we'll be seeing way more price reductions because sellers are totally unrealistic about what's happening in the market. And that's part of the reason why I'm here. So comment below. Are you seeing this in your market? Are you seeing a bunch of price reductions going on in your market? And do you think it's going to get a lot worse? Look at Arizona right there. That's obviously Florida, Arizona is the worst, Florida, and then Texas, and then the Carolinas. Prices are down specifically in the South. This is because we're just basically seeing the inverse pandemic situation here. All the people relocated from the North to the South, and now people in the South are selling out to either go back north or go back west or find another place to live because it's so expensive. But the 1 year change in metro level home prices between April 2024 and April 2025, obviously you can start to see, Cape Coral is down 8.7%, Punta Gorda is down 10.6%. Jacksonville, it says it's down only like 2.7%, but I can tell you a house that was selling for, $435 is now selling for, $380. So it's pretty significant on the drops of up to 10%. Obviously, it depends on the neighborhood. It depends where you are. It depends on how much available inventory there is, and it's very hyper local. But it feels like it's worse than what the data is saying in this chart. I mean, the market is softer, but my house is so special. Let's hold out for more offers. This is exactly what's happening right now. Sellers are getting greedy. They're waiting. They're not cutting fast enough or soon enough. They don't understand the market dynamics. And it's real estate agents' jobs to go out there and explain exactly what is happening on the ground and why it's so important to price below all of the other actives in the neighborhood, at least $20,000 lower than the other actives. If they want to get it moved, it should be staged, it should be clean, it should be upgraded. And if it's not, it's more likely that it's going to sit. We're still seeing houses that are perfect condition, everything's upgraded. Those houses are still selling. So let's deep dive in. This is one of my favorite charts that I want to go over. So as you can see, the blue is when the prices are going up and the red is when prices are starting to go down. But you could see obviously 2007 prices start going down. It gets worse in 2009. It really doesn't get much better until 2012. So it took 1, 2, 3, 4, 5 years practically to get back from a decline and start appreciating again. And then we had, this massive boom of just like pretty normal growth up until 2019. And you can see the seasonality here, right? So the best time to list your house is obviously during the spring, March, April, May, June, July, August. After August starts, after August ends, it's basically, school starts and people stop purchasing. And then, they get their tax refunds back in March, April time frame, and they use that for their down payment to purchase. And that's why you see this type of seasonality happening here on this chart. But you can see it's starting to fall off once the Fed started raising rates. This is March 2022. They started raising rates here. And whenever the Fed raises rates, it takes 6 to 8 months for it to show up in the economy. So that's where, this is exactly what this chart shows. Rates go up, asset prices come down. 2023 was still an okay year, but rates, continued to move up and during busy season, and now it's starting to fall off a cliff here in 2025. And I expect to see a lot of declines here in later of 2025. And again, this is on a national index. This is not on a local index. If it was local, I'm sure it would be a lot worse than this because there's only a few, 7 to 9 states out there that are really getting hit with home prices. Eventually, it'll go to most places, but it does take time. Real estate is illiquid, so it takes more time than, let's say, the stock market in terms of reacting to information because it can take a house, 6, 9 months to sell, and the transaction volume is much lower. What's next? The speculators who are buying these properties at the peak, these Airbnbs in 2023, they're buying rental properties in 2023. All this stuff, we expect that they're going to lose money. Of course, there's transaction costs with selling real estate, which is another issue. When you buy, you're paying 3 to 4%. When you sell, you can be paying up to 8% of the home's value. So we always say it takes about 5 years to break even just on the transaction costs alone. So we think these speculators, if they need to get out in the next 3 to 5 years, they're going to be underwater. Then we also expect there to be occupancy fraud. So there's reports out there showing that 1/3 of investors per the Philadelphia Federal Reserve were basically doing occupancy fraud, which means that they were claiming that they had an FHA loan that they were going to occupy, but they actually turned it into a rental immediately. And so this is going to be investigated. There's going to be a lot of fraud with that. There might be some clamping down on FHA. There's also massive number of FHA defaults out there, up to 15%. The government stopped reporting the data, which is really scary. And then obviously there's defaults on VA loans. And, during COVID, they had all these relief programs for people. And now those relief programs are no longer in existence and people have to start paying. So the government has to decide what they're going to do if they're going to go out there and start foreclosing on these properties. We don't have any information yet. They're actually reducing the amount of information that we get. So it'll be really interesting to see how that impacts the market and whether we see a wave of foreclosure in the next 3 to 4 years. Worst demographics for Florida. This data is really interesting. The birth rate ratio, I don't have a chart for this. I'll share it on one of my next ones, but the demographics are showing that the deaths are outpacing the births. And so if we don't have a lot of immigration into the state or migration into the state, then it's likely that we're not going to have, it's just going to be a bunch of old people and there's not going to be a lot of young folks here. And that's going to be a huge issue and a huge shift in the state of Florida. And then the student loan defaults are ruining people's credit, which is just this. I mean, it's you could not ask for a worse type of situations, like poor demographics, defaults going up, consumer maxed out, the speculators are losing money, student loans, from before are hurting people's credit, like all this stuff. There's fraud. All this stacking up at the same time where we see interest rates starting to spike, obviously is creating a housing bubble. But the weird thing is that we're seeing out there is that stocks are up. What is going on with that? So the reality is stocks are overpriced by basically every single metric that you could possibly look at. This is why I'm very careful on stocks. You'd only want to buy something if it's extremely on sale, although it's likely that in the future, even though we had a 20% run up, just within 22 days, it's very likely that we're going to see a pullback and come back to reality. There's always mean reversion in stocks, just as there is in housing. It's just a matter of time. And the smart money is sitting out on the sidelines, being patient and waiting for the right opportunity to buy versus going out there and feeling like they constantly have to be deployed in the market. So here's the sequence of events, and this is pretty true for a lot of the type of stock market declines, is it is very volatile, right? Like there will be a period of time where it'll be extreme optimism, and then there'll be a period of time with extreme fear, like back to back within a couple of months. And we could see that, we could see that in this chart. The capitulation comes later. You could see in 2007, people knew things were kind of getting a little dicey, and it still took, a year and a half for that capitulation in the stock market to actually happen. And then we saw a nice, V-shaped recovery there. But the thing I just want to bring up about this is just because we're sharing this information now does not mean that the market is going to react. The market's going to see this. It's usually accumulation of events that happen that lead to some extreme circumstance that causes the sell-off and the capitulation. So just be aware that even the stock market doesn't respond very quickly or come back to reality very quickly. It can go on for a very long time. One of the indicators, this is Michael Burry. If you haven't read The Big Short or watched the movie, you should. This was really interesting. Last Friday, this data came out, and basically he sold everything except for Estee Lauder, which is the makeup company, and then he doubled his position there. But he basically got out of stocks completely, and then started shorting the market. And so this is an indicator, somebody who is very intelligent, data driven, and has been highly successful before. He was early before. Maybe he's caught his mistake now and is seeing it differently. But when you start seeing the really smart money guys make big, massive moves, you start to pay attention and look for yourself. So that's it for today. Thank you for following.